In this video, I will provide an in-depth analysis of why Bitcoin will hit $1 million and why many, including you, could become rotten rich in a few years from now. You won't want to miss this. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Hey everyone, grab a seat. Let's get into it. So for the longest time, a lot of people, probably some of your friends, maybe even some of mine, thought Bitcoin was a total joke. They said it was a scam, it would never work, and it was just some weird internet fad. I remember a few years ago when I tried to explain the concept to my uncle, who's been in traditional finance for decades. He just laughed. He said, "That's not money, it's just a line of code." But today, the world's biggest companies, multi-billion-dollar investment funds, and even governments are fighting to get a piece of it. It's like the playground bully suddenly wants to be friends with the quiet kid who's now the CEO of a tech giant. And here's the part that sounds completely insane, but if you look at the history and the math, it makes a lot of sense. The hardest part of Bitcoin's journey is already over. The next chapter, the part that could take the price to a staggering $1 million per coin, could happen much faster than almost anyone expects. The most difficult journey is already behind us. When people imagine Bitcoin hitting $1 million, their minds immediately go to this idea of an impossible dream. They think it's a fantasy reserved for super-rich crypto fanatics or crazy doomsday theorists. But what if I told you that the real, gritty, gut-wrenching journey was actually going from $0 to $100,000? And the road from here to $1 million could be, in a weird way, easier? Now let me be clear, I'm not saying it's going to be easy in the sense of no volatility. Bitcoin's path will always be a roller coaster with steep drops, terrifying headlines, and wild corrections. That's just part of the ride. But it's going to be easier, in the sense that the forces pushing it higher are now bigger, stronger, and more relentless than they have ever been before. To understand why, we have to go way back to the very beginning. Think about the global financial crisis of 2008. The world was on fire. Banks were getting bailed out with taxpayer money, and people were losing their homes and their jobs. It felt like the entire system was broken. It was on October 31st, 2008, while all this chaos was unfolding, that a mysterious figure using the name Satoshi Nakamoto published a white paper. The paper was titled Bitcoin, a peer-to-peer electronic cash system. It wasn't just a proposal for a new digital currency. It was a declaration of war against the very system that had just failed everyone. A system where governments and central banks could create new money out of thin air, quietly stealing the value of your savings through inflation without your consent. A few months later, on January 3, 2009, the first Bitcoin block, what's now known as the Genesis block, was mined. Hidden inside that block was a message. The Times 03/Jan/2009 Chancellor on brink of second bailout for banks. It was a newspaper headline from that day. It was also a powerful statement, a permanent reminder of exactly what Bitcoin was created to fight against. The endless cycle of money printing, corporate bailouts, and inflation that erodes everyone's hard-earned wealth. Back then, Bitcoin wasn't traded on any exchange. It had no price. It was just a small, wild experiment shared among a handful of cryptography enthusiasts and what they called cypherpunks. They mined it on their personal computers, not for profit, but because they believed in the idea of a revolutionary, decentralized technology. For years, every single cent of value Bitcoin gained was a monumental battle. It had zero legitimacy, no infrastructure, and almost no mainstream awareness. The idea of it ever replacing, or even competing with a national currency, sounded like a total joke. This period was the hardest climb. It was a climb without a ladder, without a rope, just pure, blind faith in an untested idea. I remember my friend who was in that early group. He'd be running the software on his old desktop computer, and I'd ask him what he was doing. He'd tell me about mining Bitcoin, and I'd just shake my head, totally confused. I thought he was wasting electricity on something that was completely pointless. He wasn't mining for a profit. He was just participating in what he saw as a crazy, idealistic experiment that only a few hundred people in the world even understood. The early mining rigs were just regular home computers, humming away in bedrooms and basements, running software that most of us would have called a total waste of time. It wasn't on Wall Street. It wasn't on CNBC. It lived only in obscure internet forums, the kind of places where usernames mattered more than real names and debates about the future of money felt like science fiction. The spark that proved it all. Then finally came the first spark of real-world value. May 22nd, 2010. A programmer in Florida named Laszlo Hanyecz posted on a Bitcoin forum with a simple, yet groundbreaking offer. He said, "I'll pay 10,000 Bitcoin for 2 large pizzas." Someone took him up on it. Laszlo sent the coins. The pizzas arrived. That single moment, which we now call Bitcoin Pizza Day, was the first recorded exchange of Bitcoin for a physical good. At today's prices, those 2 pizzas would be worth billions of dollars. Back then, they were just dinner. But more importantly, they proved one thing. Bitcoin could leave the digital bubble and buy something in the real world. From there, a tiny market began to form. In July 2010, Bitcoin appeared on some early online exchanges, priced at around 6 cents. Trading volumes were laughably small, sometimes just a few $100s a day. The price jumped to a few cents, then slipped back. But by February 2011, something incredible happened. Bitcoin reached parity with the US dollar. For the small group of believers who had been mining and holding for years, this was total validation. For everyone else, it was a curiosity at best and a joke at worst. What no one realized yet was that Bitcoin was about to face its first big tests. Tests that would decide whether it was just an internet fad or the beginning of something unstoppable. By late 2013, Bitcoin had done the unthinkable. It had climbed from being worth a few cents to over $1,000 per coin. The media was suddenly fascinated. Headlines screamed about digital gold, and early adopters were called geniuses. But in the shadows, a disaster was brewing. At the time, a Japanese-based exchange called mt.gox was the beating heart of the Bitcoin world. It handled around 70% of all Bitcoin transactions worldwide. If you were buying or selling Bitcoin, chances were it went through mt.gox. And then it happened. Hackers breached the exchange. Hundreds of thousands of coins vanished. Estimates vary, but some say it was close to 850,000 BTC. It was a catastrophic event. Almost overnight, the price collapsed from over $1,000 to about $380, and over the following months, it slid even further, eventually hitting lows near $150. For many, this was the end. News anchors and finance experts declared Bitcoin dead. They called it a scam, a bubble, an experiment that had finally failed. And honestly, it could have been. If the community had lost faith, if miners had shut down their machines, if no one had cared enough to keep the network alive, Bitcoin would have vanished into history, remembered only as a weird footnote. But that's not what happened. Instead, a core group of believers doubled down. They kept mining. They kept building. And slowly, painfully, the price began to recover. By the end of 2017, Bitcoin reached $20,000. Then came another brutal crash. This time, it dropped to under $3,000. And yet again it climbed back. In 2021, it hit $67,000, only to fall below $16,000 the next year. Each cycle was the same: a massive rally, a brutal correction, and a recovery that set a new all-time high. But with every single cycle, something else was happening that changed everything. The institutional onslaught and the ETFs. For most of its life, Bitcoin was powered by individuals, tech hobbyists, libertarians, risk-takers, mining coins in spare bedrooms. But over time, the players got bigger. Much bigger. One of the clearest signs came from a US-listed technology company called MicroStrategy. After the pandemic, with governments printing trillions of new dollars, the CEO, Michael Saylor, had an epiphany. He realized that holding large amounts of cash was like holding a melting ice cube. Its value was disappearing. So, he made a radical move and started converting the company's cash reserves into Bitcoin. And he didn't just do a little bit, he went all in. MicroStrategy started buying aggressively, even borrowing money to buy more Bitcoin. Today, it holds a massive amount of Bitcoin, representing a significant percentage of the total supply. Some called it reckless, others called it visionary. But here's what matters: it wasn't just MicroStrategy. Other corporations joined in. Tesla added Bitcoin to its balance sheet, and companies like Coinbase and Marathon Digital have done the same. And even governments, yes, even they have entered the game. The United States now holds a significant strategic reserve of Bitcoin, much of it seized from criminal cases. If the largest economy in the world is openly holding Bitcoin, do you think other nations will ignore it? This shift from small, individual players to global giants changes everything. Because now Bitcoin's price isn't just driven by retail traders on crypto exchanges. It's being driven by massive, institutional demand. This is why Bitcoin could hit $100,000 in 2025. And that demand just got a serious turbo boost. In 2024, the first U.S. spot Bitcoin ETFs launched. For the first time, investors could buy exposure to Bitcoin directly through their traditional stock market accounts without setting up a crypto wallet or learning about private keys. The adoption rate was faster than almost anyone predicted. When gold ETFs launched in 2004, it took them 2 years to reach $10 billion in assets. The Bitcoin ETFs hit that number in just 7 weeks. By the end of 2024, the total assets in Bitcoin ETFs had already surpassed those in gold ETFs. Think about that for a moment. A 15-year-old digital currency outpacing a 5,000-year-old store of value in the race for investor money. And there's a financial incentive for the companies running these ETFs, too. BlackRock's flagship S&P 500 ETF charges a fee of just 0.03% per year. Its Bitcoin ETF charges 0.25%. This means that even with less total money invested, the Bitcoin ETF can generate more revenue. Do you think a company like BlackRock will be shy about promoting a product that earns them more money? They will push it to every corner of the market, which will only drive demand higher and higher. This is a crucial element in understanding the Bitcoin price prediction for 2025 and beyond. The halving. Why scarcity is a superpower. Every asset in the world has a supply story. Real estate can be developed. Stocks can be issued. Gold can be mined. But Bitcoin has a hard cap. 21 million coins, not one more ever. That fixed limit is enforced by code. And it's not just a static ceiling. The way new coins are released follows a strict schedule that makes Bitcoin scarcer over time. This happens through an event called the halving. Roughly every 4 years, the reward that miners receive for validating transactions is cut in half. In 2009, miners earned 50 BTC for each block they mined. In 2012, that dropped to 25. In 2016, to 12.5. In 2020, to 6.25. And in 2024, it dropped again to just 3.125. This process will continue until around the year 2140, when no new Bitcoin will be created. The effect of each halving is simple but powerful. The rate at which new coins enter the market slows dramatically. Meanwhile, demand, especially now with institutions, ETFs, and even governments, continues to grow. It's basic economics. When supply shrinks and demand rises, price pressure builds. In the early days, this was a slow burn. Back then, a halving barely made the news outside of crypto circles. Today, it's front-page material for major financial media. Why? Because each halving now happens against a backdrop of massive global demand. Think about it. When the reward dropped from 6.25 to 3.125 Bitcoin per block, the daily supply of new coins instantly fell from about 900 to 450. That's 450 fewer coins available every single day. At current prices, that's hundreds of millions of dollars in new daily supply gone. So, who gets the remaining coins? The same institutions and funds we talked about earlier. The ones who can buy an entire day's worth of supply without even blinking. And here's where it gets even more intense. Even without halvings, a huge portion of Bitcoin's supply is already locked away. Some is held by long-term believers who never sell, and some is lost forever in forgotten wallets. A friend of mine once tried to recover an old Bitcoin wallet from a computer he hadn't used in years. He had the address, but couldn't find the private key. He spent weeks trying to find it, and eventually gave up. That Bitcoin is likely lost forever. This means the true available supply is far smaller than 21 million. Some experts estimate it's closer to 14 or 15 million coins in circulation today, and that number is shrinking. Pair that with a tidal wave of institutional buying power, and you begin to see why Bitcoin's long-term value and a price of $1 million aren't just clickbait, it's math. The Bitcoin heartbeat, a journey to $1 million. Bitcoin's price history isn't a straight line. It's a heartbeat, sharp surges upward, followed by gut-wrenching drops, then a recovery, and then a new high. These cycles aren't random. They've been closely tied to the halving schedule for more than a decade. Here's how it plays out. The halving cuts new supply in half. Supply shock meets steady or growing demand. Price begins to rise slowly at first. Momentum attracts more buyers, media attention, and eventually FOMO, fear of missing out. Price accelerates into a parabolic climb. Speculation overheats. A sharp correction wipes out the weakest hands. The price stabilizes far above the previous cycle's low. This has happened in 2012, 2016, 2020, and is already unfolding after the 2024 halving. But here's the important part. Each cycle builds on a higher base. In 2013, the top was around $1,000. In 2017, it was $20,000. In 2021, it was $67,000. Even the crashes aren't really a return to zero. They're simply retracements to levels that would have been unimaginable just a few years before. Why does this matter for a $1 million price target? because the scale of each cycle is getting bigger. When you start from a higher base, each percentage gain translates to much larger dollar moves. And now, with institutional money in the mix, the upward phases can be sharper and the floors can be higher. Yes, there will still be corrections. The journey from $100,000 to $1 million won't be a smooth ride. There will be moments when headlines scream that Bitcoin is dead again. But if the pattern holds, each recovery will set a new record. And here's a hidden advantage of these corrections. They shake out short-term speculators, leaving coins in the hands of long-term holders, the people and institutions who aren't selling anytime soon. This makes the supply even tighter when the next wave of demand hits. In other words, the very volatility people fear might be the fuel that drives Bitcoin higher. From the outside, $1 million per Bitcoin sounds outrageous. From the inside, when you look at the math, the history, and the market dynamics, it starts to look almost inevitable. The hardest climb was the first one. Going from $0 to $100,000 meant surviving 15 years of skepticism, technical challenges, exchange hacks, government hostility, and gut-wrenching crashes. It meant building the entire infrastructure from scratch: wallets, exchanges, custody solutions, and legal frameworks. That work is done. Today, Bitcoin is no longer an untested experiment. It's a globally traded asset with regulated ETFs, audited custody services, and adoption by some of the largest financial institutions in the world. And here's the kicker. The very forces that once mocked Bitcoin are now helping it grow. Central banks continue to print money at a record pace. Debt levels in major economies are exploding. Inflation, even when officially under control, quietly erodes purchasing power year after year. In that environment, the appeal of an asset with a fixed supply isn't just a niche idea. It's common sense. This is why corporations like MicroStrategy, funds like BlackRock, and even governments are holding Bitcoin. They're not betting on a tech fad. They're hedging against the fragility of the system they operate in. If that sounds dramatic, remember that gold became a global store of value for exactly the same reason. And unlike gold, Bitcoin can be moved anywhere in the world in minutes, stored securely without physical risk, and divided into tiny fractions for everyday transactions. This is why many people believe it's the best long-term crypto investment. Now, add the numbers. If global demand pushes Bitcoin's total market value to around $20 trillion, less than the current market cap of gold, the price per coin would be roughly $1 million. That's without assuming any extreme scenarios, just a level of adoption gold already enjoys. And with the combination of shrinking new supply, massive institutional inflows, and growing government interest, that $20 trillion market cap doesn't sound far-fetched at all. Could it happen in under 10 years? Yes. The past cycles suggest it could happen even faster if momentum aligns with a major global economic shift, the kind we've seen more than once in just the last 2 decades. The truth is, the more unstable the old system becomes, the more attractive Bitcoin looks. And the more attractive Bitcoin looks, the faster it climbs. The journey to $1 million won't be a straight shot. There will be brutal corrections, moments when fear takes over, and moments when even seasoned investors will question everything. But if history has taught us anything about Bitcoin, it's this. Every crash has been temporary, and every recovery has reached new heights. The difference now is the scale. What was once driven by a small online community is now fueled by the largest financial engines in the world. What was once dismissed as magic internet money is now being added to balance sheets, investment portfolios, and strategic reserves. The biggest challenge is no longer whether Bitcoin will survive. It's whether you'll still be watching from the sidelines when it thrives. Because if you zoom out, the story becomes clear. Bitcoin's first $100,000 was the uphill battle. The next $900,000 is gravity on your side. And one day, maybe sooner than you expect, you'll look at the price and realize the hard part was already behind you. From that moment on, the question won't be, will Bitcoin reach $1 million? It will be what happens after it does. Every dollar you exchange for Bitcoin today is like a financial worker that never sleeps, never takes a vacation, and never asks for a raise. It just works silently and relentlessly, building a future that's not limited by the decisions of central banks or the whims of politicians. If you found this helpful, please subscribe, hit that like button, and leave a comment below. Disclaimer: this video is for equipping, educating, and empowering and should not be considered financial advice. Investing involves risk. Always consult with a qualified financial professional before making any investment decisions. Your financial well-being is paramount.